Good morning, everybody. Happy Friday. Welcome to this week's long form episode on the podcast. And Trevor Hall here, your host, obviously on the road a little bit this week, coming to you from the great state of Nebraska, where I'm actually going to get a site visit in this week, if you can believe it or not. But it's Friday, and that means it's time to step back from the daily headlines and take a broader look into what is really driving the mining commodities markets. And we're going to do that today with our friend Sam Broom from Sprott, someone I always enjoy speaking with and catching up because he's never afraid to really challenge the consensus and think several steps ahead of where the market is today. So this conversation comes in an interesting moment. Gold correcting sharply from its highs. Sentiment across the mining equities has really deteriorated, and many investors are questioning whether the bull market has already run its course. But Sam, he argues the opposite. We discussed what today's environment looks like as a healthy reset within a larger secular bull market, and why this could be one of those rare periods where long-term investors are rewarded for leaning into weakness rather than running from it. As always, we give thanks to Revival Gold, Integra Resources, Visa Silver, and Equinox Gold for their continued support of Mining Stock Daily. Let's jump into my conversation with Sam Broom. Have a wonderful weekend, everybody. Be well. Oh, Mr. Sam Broom, it's time for annual catch-up with one another. I think we tend to get one of these in at least once a year. And I was going to try to do it here in Boca Raton in a couple of weeks' time, but you will sorely be missed, my friend.
Yeah, good to see you, mate. It's been a while. Unfortunately, blew out my Achilles recently, so won't be trudging around Florida this year, sadly. But have fun, mate. Have a good time on my behalf.
Well, there'll be zero fun without you. I promise you that. Okay, Sam. You will be missed. It's good to have you on. Listen, it's just kind of fortuitous, and maybe not fortuitous, but you and I are connecting midweek, last full week of June. We are seeing what appears, in my mind, a little bit of capitulation on the gold market. Every single day, making new relatively lows, tagging that $4,000 level. Per ounce mark on the chart. Gold equities, absolutely getting hammered. And I still have to scratch the back of my head here, Sam. Like, if you're a gold producer, you're still making a ton of cash per ounce produced here, unless you're really screwing things up. But maybe we're not surprised about this capitulation, about this move, but are we surprised about the sentiment at all?
It's almost so bad it's good all of a sudden, right? I mean, I don't know. It's been an interesting correction. It's certainly corrected a bit more than I thought as my base case. Things got a little frothy earlier in the year. When silver sort of had that moonshot end of January. I kind of quite a bit before that, I'd stepped away from being aggressively buying. Just sort of thought, we're due a correction. These things always come. 25% is pretty normal. That 20 to 40% correction within a bull market's, they're going to come. They always do. Every bull market, you never know when. So we've certainly got that now. Initially people were talking about it being Iran related. I do think there was probably a component of a subset of the major buyers stepping away. A lot of the Gulf countries have been historically large buyers of gold. When their revenue stream temporarily went away with the Strait of Hormuz closure, it's logical sense to assume that a big buyer steps away, prices decline to some degree. So I think there was a part of that. But if you really look at when it started really, moving lower, it was really around the Fed nomination and the sort of perception that the Fed under Wart might be more hawkish than previously thought. He wasn't the front runner. He was kind of a somewhat surprise pick in the end. Everyone was kind of touting Trump wanting a loosey-goosey Fed that's just going to ease into oblivion and, growth at all costs, long-term,
Right.
by the wayside kind of a Fed chair, or at least that was the just what people thought he was going to go with. So he has been surprisingly hawkish, and I think that's probably the biggest driver at the moment. Especially with that some of that central bid moving away, at least the Middle Eastern oil producing nations stepping away. Precious metals have moved back into being a bit of a macro play thing. If you look at what gold has become correlated to since sort of that March, late February, early March period, there's very close correlations again to both the dollar and bond yields. For a while there, gold completely decoupled from its historical correlation or inverse correlation with those two things. So since then, it's kind of back, being driven by those key factors. Ironically, people are worried now about rate hikes and the impact that might have on gold. And then, historically, the data is a bit mixed on whether rate hikes are actually bad for gold or not. It's kind of almost the worry of rate hikes or the anticipation of rate hikes that have been problematic for gold. What I'm seeing in a lot of the forward-looking data actually suggests that inflation's about to roll over. And if anything, the data looks like we may be in for a period of disinflation here for, fairly soon. You're seeing that in the break-evens, what the differential between nominal and, sort of the inflation-protected bonds are showing data that's showing inflation expectations rolling over. If you look at kind of the core CPI numbers, they're sort of flattening and rolling over. Some of the things that were elevating recent figures, particularly the energy input costs, all of a sudden we've got oil from 110 back down to sub 70. So that's almost certainly going to roll over as well. Shelter and rent, which is a huge part of it, looks like it is rolling over and looks like it's going to continue to roll over, or at least remain flat. Wage growth is pretty anemic. All the core leading indicators actually look kind of disinflationary, frankly. So I don't know. It'd be a very Fed thing to do, wouldn't it, to sort of get super hawkish right as stuff was kind of rolling over.
It was pretty interesting with Warsh's first meeting last week. I mean, you kind of felt that he needed to come out there and kind of put his stamp on who he was and what he was going to represent at that podium as the head of the FOMC, right? So I don't think anybody thought he'd just come out there and do exactly what the administration wanted him to do. Like, he needs to make that position his own, right, moving forward. And so I do think he kind of stood his ground pretty well. But I mean, Sam, I think we both know, as soon as there seems to be cracks widening in the system, nothing changes. The Federal Reserve will come out and do exactly what they need to protect themselves, protect the economy at any means necessary, right? And they'll use the same tools they always do.
Yeah, it's exactly like you said. How many times with a company have we seen a new CEO come in and they clean the decks, and there's a bit of a drawdown initially because they kind of daylight all the sort of cockroaches under the rug, to clean slate with a new guy in power. His first address did feel a little bit like that. But like you said, I'd be very, very surprised if we can sustain rate hikes from here, and dollar levels much higher than we're currently seeing, because that's the other side of this coin, right? We're seeing a massive sort of 18-month range breakout in the dollar moving higher without major problems starting to crop up around the global financial system. To your point, we all know, everyone listening to this podcast is probably well aware of the long run macroeconomic situation and the sort of totally unsustainable global debt levels. You run the numbers on just rolling over the on balance sheet stuff at 4-5% rather than sort of 1-2% of the prior sort of 20 years, and the numbers get pretty scary pretty fast. So the question is, how long can this sort of facade of the ability to rate hike go on for before problems happen and you sort of return to sort of either overt or stealth kind of stimulus again? That's a hard one. I don't think anyone really truly knows. But I would hazard a guess we can't be too far away. I mean, I think, the sort of measured move on the dollar is about 105 on the DXY, which,
Right.
if we get up near there, I'd be very surprised if we don't start seeing cracks emerge as we approach that level. You know, so there's a whole lot of indicators out there right now that have me kind of interested, let's say, on making some moves. I mean, there was a long period for the last year where you were set and you were kind of just letting it play out. This period we're in now, at least in the mining space, the flow-on effects for what we're seeing in precious metals and mining equities. This is the first period in at least sort of 12, 18 months where I feel like there's actually quite a bit to do out there.
Mm-hmm. Yeah, so there's a lot of things that make me pretty excited about right now. Same with you, but you talked about the dollar way overbought right now. So obviously the technicals would maybe move its way into maybe thinking about some sort of pullback in the dollar. But sentiment in gold, as we mentioned, nobody wants it, nobody cares. Like it's a screaming, completely different story as it was at the end of January where everybody wanted it, and that's where we got the pullback. But now it's like it's an afterthought, right? And so just from the sentiment and just moves in the dollar plus cracks in the headlines, I keep going back thinking about PIMCO's call for, uh, you know, uh, credit volatility problems. That was a couple of weeks ago. And then doing a lot more reading. And I think people are starting to figure out how this AI trade is actually manufactured, and seeing cracks in that. I mean, I think a lot of people are a little bit more concerned now about what the second half of the year potentially has in store. Now, I'm not saying there's going to be, you know, a great, a GFC or anything, but people are generally starting to figure this out, that maybe it's not as, the wind to our sails isn't necessarily there. In fact, we may have a few more headwinds. And that's completely bullish for gold, right? Uh, and at the same time, everybody's sold their mining equities, and and now it's like almost bid only.
Yeah, it's interesting. I mean, you got to be a little bit careful what you wish for, right? Because if the broader market gets bad enough and liquidity just completely evaporates, we'll probably
Hmm.
get caught up initially, even if we've already had a decent drawdown, right? It tends to be the case that if it's a liquidity style panic, we'll probably get caught up in it too. But if it's a rolling over, almost a bit like 22, 23, when that sort of turns, it tends to be very good for what we do. Um, and we're unlike back then, we're very beat up already, right? Like the valuations on offer across this space, like you said, even at $4,000 gold, where most miners have got kind of at least a $2,000 an ounce all-in margin. At least the good, well-run, sort of lowest cost quartile producers do. I mean, profitability is phenomenal. One common question I get from clients and people asking about the space is, oh, what's the risk we go through a sort of 2012 to 15 style 80% equity drawdown? Um, I think it's worth remembering that back then the industry was in a completely opposite space than it is today. I mean, if you go back and look at balance sheets, this industry as a whole was levered up to the gills,
Okay.
mostly with piss poor, growth at all costs kind of assets that assume gold prices were only ever going to go up for forever. The amount of write downs that were experienced over that 3-year period, and the amount of sort of near death experiences that occurred across the industry were kind of staggering. And there was a genuine permanent loss of capital type of event back then. You fast forward to today, you know, the best, the top producers are all net cash on the balance sheet, pristine, huge piles of cash, buying back stock, paying increasing dividends and spending on, quality growth projects. The boards are all kept in check because people are still, you know, scared crapless that this is going to happen again. So, making sure growth is good growth, not just growth for any growth's sake. It's a complete polar opposite. So, unless you're worried about gold going back to $1,500 an ounce again or something, which, I can never say that can't happen, but I think it's a fairly low probability.
Hmm.
You look out there, you look at a scenario like this and you go, where's the best of the best, and you just kind of close your eyes and start accumulating. That's my view. I think we're at one of those periods. You might get a couple of these periods a decade where it pulls back this much and sentiment shifts this low. In my career, I've been doing this for well over a decade now, and much longer than that before working at Sprott, just privately. I mean, when it feels like this, it's usually, I would say, almost 100% hit rate. That it's, if you look forward 3 to 5 years, you'd wish you'd bought more when
Yeah,
sentiment and
yeah,
setup was like this. So
yeah.
it's kind of where I'm
But
at the moment.
what is this latest move in the last couple months done with M&A activity? I mean, we've seen some really good mergers and acquisitions here in the last 6 months, Sam. But maybe has this pullback in the gold market and along with the equities, has that maybe tabled some of those negotiations amongst peers that were looking at an acquisition or a merger of equals?
Possibly. I've thought about this a lot. In some ways, I think it might actually usher in an accelerated wave of M&A, particularly if the buyer has cash, right?
Hmm.
If you're sitting on a pile of cash and you've been looking at potential M&A candidates, and all of a sudden their stock's off 40 or 50%, and you've got cash sitting there you're going to pay with, that's just gotten, you've got a 50% discount. If you're having to use your equity, if your cost of capital is your equity and your equity's taken a similar hit, then it's not as attractive, right? But there's billions of dollars sitting out there at the large, mid cap, and large cap end of town right now, with just huge amounts of cash that, you know, I think is going to start getting more aggressively deployed at these levels. The question is, are the acquirees interested at parting, with their companies for cash at this depressed levels? I'd be a little disappointed if one of my top picks kind of threw in the towel, and sold out for a cash buyer at this juncture. You
Yeah.
know, so in some ways, I hope it doesn't happen. At the same time, if an acquirer does use script, and it's a acquirer that I like and think is going to do a fantastic job at developing the asset and unlocking the value. If we're specifically talking about single asset developers, which I think is an interesting place right now, then yeah, I'm actually not too upset. If this little wobble in the market was what was required to get the dance partners to come together, then so be it. If I like the equity I'm getting, and there's material upside to the acquirer from the asset they're acquiring, I'm all for it.
I think we saw a lot of activity mostly on the gold space. Not so much, although I think it's been anticipated that we'd see more in the copper space, but you're talking a lot of large scale copper, which obviously comes with precious metals kickers oftentimes. But are these things teed up? If we talk about, what's the next logical step towards building tier one copper deposits? I, I mean,
You got to
are
find
we?
them first. Yeah, there's so few
Well,
of them.
there's very
Yeah.
few, right? I mean,
Yeah.
you and I could probably come up with a half a dozen right at the top of my heads, but it's not something those things are just flying off the shelves right now. They take a lot of time. I mean, what is this holdup? Do people really like? I mean, is it just capex alone and the allocation of capital for decades and decades that is taking longer than a typical gold project?
Well, there's just I mean, a lot of the copper producers tend to be a lot bigger, right? They're sort of almost
Right.
quasi majors, or very large mid caps, more so than the gold space, where there's, dozens of these mid caps that are more interested in a kind of true low to mid tier two type project. So, there's just been very, very few truly tier one copper discoveries in the last 20 years. So there's just not the
Right.
project pipeline in the copper space that's going to move the needle for even a Lundin. We've obviously seen them acquire one of the most obvious, you know, tier one discoveries in the last decade. but like, there's just not that many projects that move the needle for them that are being discovered, and there's just not that pipeline of mid-cap company that's interested in the smaller companies that, there's just not the ecosystem there, both from discovery, and the quality of those discoveries through to the bigger cap companies. Yeah, I mean, I struggle. I mean, I go into every year with a wish list. And as much as I love the precious metal space, I keep telling myself like a new, genuine tier one copper discovery would be probably the thing I go into each year hoping comes from the market this year, because they're just so rare. When they do
Yeah.
arrive, it's a fun ride.
What is on that list? Is it jurisdiction? Is it grade? I mean, I keep
It's
going
just
back in
size.
this.
It's
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 just
it's grade
size,
and size.
scale.
It's
Okay.
scale. It's you
Yeah.
need you need either like a billion ton, 0.7 plus copper equivalent porphyry somewhere, or you need like a Kamoa-Kakula style, massive high grade over, basin scale type stuff. Otherwise it's just small fry. Um, it's not
Hmm.
worth sinking in the billions of capital for average project for these guys, and they're just all the easy porphyries have been discovered in the Andes. Or I shouldn't say all, but the easy ones have been found. That's where a lot of these big discoveries are. You're having to go to other places like Kazakhstan's heating up a little bit
That's
in the copper
exactly what I
space.
was thinking.
You got to go, Europe, Eastern Europe. There's the belt through there that you can argue is underexplored. There's big porphyry centers in Asia. There's a company I'm invested in the gold space, but they've got a giant big porphyry target in Cambodia that looks interesting. But you're
Oh
starting
wow.
to have to go to these sort of more far-flung places, these porphyry copper belts, to find these tier one things. Um, yeah, because the easy ones have been found. There's no two ways about it.
Yeah. On top of the copper thing, and I think a lot of people listening will know that, and I've expressed this concern a little bit in the last couple of weeks. Obviously, I'm long term very bullish copper, but I question how much of that bullishness is really focused on the AI and data center build out. And we keep on talking about how much demand of copper there will be to produce all these data centers. And as I had mentioned in earlier part of this conversation, Sam, those cracks in artificial intelligence, the economics of it all, and how much data centers actually being built are now being really, really challenged, not only from the basic economics and investment standpoint, but um, from jurisdictional and social risk. They have the exact problems any mine does, needing buy-in from community support. So I'm just, and I'd love to kind of bring this up with you and get your sense. Are we maybe over allocating too much bullishness in the copper space based on AI? And what happens if that doesn't come to fruition?
Yeah, it's a good question. It's hard for me to accurately answer because a lot of it I think comes down to sentiment. There are
Mm,
commodities that tend to get bought because they're part of another basket, as a core thematic. For example, uranium gets bid up a ton whenever, the same AI basket, right? Because it's the energy required to power these AI data centers mean that you get these ETFs and things that have an AI thematic that, you find Cameco and stuff like that, in these baskets. Copper's probably a little bit the same. I've seen some AI funds and ETFs that have got copper producers in the AI basket. And I have been a little bit surprised with copper's strength. I'm very bullish on copper, but seeing it sustainably here above $6 is probably higher than I would have thought coming into the year, just on the current in your face fundamentals for the stock. You got
mhm.
to remember with copper as well, there's still this sort of pending risk of tariffs in the US. So there's kind of been some non purely traditional fundamental drivers that's kind of almost creating a stockpiling bid for copper. So for me, the bigger risk in the sort of midterm, call it the next couple of years, is probably less that AI is a bust, because you look at the numbers and depending on what figures you believe or look or use, somewhere between 500,000 is probably the most accurate number, but up to 1 million tons per annum is currently going into data centers. So that's about 1.5% of global copper use. So it's a meaningful demand driver, but it's kind of on the fringe. It's almost a rounding error. It's just, I'd call it slightly more significant than a rounding error at the moment. And
Hmm.
you look at the aggressive assumptions going out 2030, 2035. Some people have it getting up to 6% of total demand, which at that point it would be a major demand, but probably consensus is somewhere around 2.5 to 3% 10 years out. So it's meaningful, but it's not driving the bus, right? It's kind of, it is incremental demand for sure, but we can discuss the supply side later, but I think the supply side drivers are going to be more important for where the copper price goes rather than AI data center demand specifically. Yeah, where was I going to go with that?
Well, where are we at with supplies right now? Last I had heard is, there was a lot of overstocking going on in China, and inventories in the U.S. seem to be at pretty good levels. Yet the copper price, I mean, as of a couple of weeks ago, copper prices were keeping, rising higher and higher. But yeah, now coming down.
Yeah, so that's where I was going to go. Yeah, so for me, the bigger risk than the data center sort of narrative in the near term is actually that the tariff dynamics change, and all of a sudden that sort of stockpiling bid goes away, or might even go into reverse. Right? You don't have to be a genius to realize that if all of a sudden we're not worried about a sort of tariff caused price differential, some of that stockpile that's built up in the US, which is significant, right? There is a
Hmm.
historically quite large copper stockpile now sitting in the US, right? It's drained from Asia and a bit from Europe. Um, but if that goes into reverse and it's all of a sudden there's excess supply here in the US and it flows back out into the global market, then I can see copper going through a pretty sharp, you know, short to mid-term correction. I don't think that's highly likely. I still think there's a narrative about critical commodity scarcity that's I don't think is going to go away, and I think with the geopolitics in the world only sort of getting more funky just about every year we hear, I think there's going to be an increase in kind of hoarding activity by sovereigns,
Hmm.
if anything, rather than a complete reversal. But you may well get short periods where that's not the case and that material comes back into market. But yeah, I mean, I wouldn't say I'm worried about the copper price right now, but like I said earlier with precious metals, I've kind of stepped away a little bit from accumulating copper names because it's not where I would call it a bargain, really beat up sentiment wise and price
Yeah.
wise right here. I'm just kind of like holding the quality exposure I have, realizing I might experience a bit of a drawdown. And, if we get a kind of moment like we get in the precious metals now, that'll be the moment to step back in and start accumulating. It's kind
Yeah.
of in your classic hold period for me right here.
Yeah. Can we talk about critical metals, critical minerals? And this has been, I'm actually it's been a head scratcher for me because a lot of the news headlines it continues to be very supportive for the reshoring the supply chain for critical minerals back to the US. And I know obviously we're not quite there yet, but there have been good policies put in place, and obviously money is available to make sure that the resupplying continues to move forward. We're seeing, processing centers get support. Energy Fuels had a huge loan from the White Mesa Mill last week, I think it was. And you would think that at any other time, if we continue to get this much support and policy out of Washington for this, the market would continue to scream higher, but it's like just doesn't care,
Yeah.
And I'm just kind of if that, so it's pretty obvious that froth, the critical minerals froth came off in that very quick cycle last year. But I'm just kind of wondering if it's more or less kind of a wait and show me type of thing, that this is actually a thing, not just a headline and floating money, or if it's just really representative of where we are in the market where, the capital is just flowing somewhere else or not flowing at all.
My gut feeling response to that question is a combination of all of the above. We're clearly in a market dynamic now that commodities of all sorts, whether it's pretty much everything, right? I mean, even
Yeah.
copper's come off a bit now. but energy, all the commodity plays. We're very much macro play things, right? We're not Tom, Dick, and Harry don't go out and buy resource stocks, or at least at this point in the cycle, at least since the mid 2000s kind of era where commodities, emerging markets were all the rage. Like we've never re-entered a market like that where large amounts of generalist money are flying into our space, right? So we're kind of dealing with the macro changing of the winds, and the winds are blowing against us right at this very moment. In saying that, when you neglect a industry for as long as the West has the critical minerals and commodity space in general, you can't just throw, a few $100 million or a few $1 billion into the space in a 12, 24-month period and expect all your problems to go away, right?
Right.
The problems that are facing, US, but it's not specific to the US, have been building for multiple decades. Probably, I mean, even last cycle, right? It wasn't. You've probably had 30, 40 years really since massive capital expenditure cycles have flown through into the mining space in the US. So the problem you've got is, you've got kind of risky or non-tier one projects you're having to throw money at, with in an industry that's lost a whole bunch of its expertise and experience just through attrition, through tough markets, and that you're trying to solve or reinvigorate by just throwing money at it, and that's not, that may help on the fringes initially, but it's not going to solve your problems. Like you really do need full cycle kind of effort and money and expertise, and you need that whole new generation to come through to really fuel that kind of real outcomes. So
Yeah.
I think capital might be a little bit skeptical that, what they're doing is just gonna be. There's a lot of risk in there, put it that way. You know what I mean?
Yeah. Yeah.
like I
Well,
look at the money, where the money's being spent, and I'm kind of going, ooh, I'm glad it's happening, but I don't know if I'd be throwing that quantity of money at it if it was my personal capital.
yeah. It's just been wild because another big headline that hit. The U.S. announced $17.5 billion in loans to build 10 nuclear reactors, not just SMRs, like huge AP1000s, right? And
Yep.
any other time, Sam, that news would just turn uranium stocks flying higher, like flying higher. And
Yeah.
what are they doing this week? Fuck all. They're not doing anything.
Yeah.
You
I
know?
mean, and even that's compounding on last week, right? Canada basically came out calling for a Canadian nuclear renaissance, right? And how they were going to
Right.
fast track all these permits and spend all this money growing the nuclear industry. Um, you know, and yeah, I mean, that's a classic one. I mean, Cameco is a very big, real tier one sort of company, right? And the fact that they're not moving on this is a pretty interesting sign. I think that's a good point. But just sentiment and the sort of, like I said, the whims of the market right now are just not moving in the way of, there's no tailwinds. There's not even a neutral wind, right? We're battling major headwinds right now. And I do think that's going to change here. If I had to guess, sometime in the not too distant future. But for now, when you're a macro asset class, and things are going against you, you can yell
Right.
into the wind all you want. It's just the way it is. You and I have both been in the space long enough. You know how it works.
Yeah.
You just have to learn to use that to your advantage. You realize you're never going to pick tops and bottoms. You realize things are going to go tough. They're going to be tougher for longer than you expect. And when that happens, you don't piss around trying to buy the cutest, cheapest, speculative, leveragey thing. You go and you find what's quality, and you just slowly sort of dollar cost average, chip away, and accumulate positions. While to the cliche, the Rick cliche, that when you know everything's on sale, don't buy Chuck. Go out and buy the fillet, and know you're going to be made whole, and then some.
Right. I think 2025 was a great year for funding exploration throughout the board. There was a lot of capital coming into the space, tons of finances, big finances. And, it was about a year ago, people were telling me it's almost easier to go out and raise, you know, a- like 50 million or $70 million rather than like $5 or $7 million, right? Like finances wanted big capital, and that would seem to be the easiest way through. But either way, I think a lot of these companies are super grateful that financing would open with the fervor that it did, because that means they're now out in the field doing the work. I guess what was yet to be seen here, Sam, is if there's a market that's supportive of rewarding the good work. So how do you kind of feel with those maybe down the chain, higher speculative, higher risk exploration plays right now?
I, like, my personal investing style is that when you get a really beat up market, I focus on quality. I mean, and that
Mm-hmm.
exists across the whole gamut of the spectrum, right? From royalty companies, producers, down to explorers. So I look at all the explorers that are either got a brand new or relatively new discovery that has the potential to be world class, or these days, a strong tier two is the new tier one kind of thing,
strong,
right? And
strong
there's
tier two.
always these names that you kind of liked when you first saw it, but you thought, oh, I'll wait for it to get a bit cheaper. It's popped 50% on the drill hit or whatever, and then they put out another drill hit, or the stock keeps running, and next minute it's 3 or 4x above where you first liked it. Those sort of stories I'll look at and I'll nibble away at for sure.
Mm-hmm.
Um, I tend to stick to that end of things. Like I'm probably less interested today at like pre-discovery grassroots stuff, just because I don't need to go there today to
Mm-hmm.
find stuff I think's just silly cheap. I'd much rather take on less risk with a bona fide discovery in hand, or at least something that looks like it's got a very good odds of doing so, or becoming one, than like go really out into the moose pasture, just when markets are this beat up, right?
Yeah.
Um, so that's my preference right now, and there are a handful of things out there that kind of fit that bill. Um, yeah, but I can't stress. I say this to my clients all the time, like quality. Don't think you need to go out and buy the most leveraged thing because it's the bottom and you want that. Go for that 20 bagger kind of thing off the lows. I mean, even today I was looking at Cameco, right? We were talking about earlier.
Yeah.
If you bought Cameco, if you really want to cherry pick and pick the absolute bottom in, the COVID era, kind of March 2020, you'd have a 20 something X today from that low. But if you take a wider window, there was about a 5 year period where it averaged about 10 to 12 bucks. I mean, you'd have a 10X just buying Cameco over a 5 year window when uranium sucked, and you'd have 10X your money today buying Cameco, like the biggest, highest quality name in the space. So when you get
Right.
these kind of really beat up sentiments, I think you people assume they have to go hyper speculative to make multiple times your return in this space. And that is fun, and you can do that, but you have to be aware you got to take on a shift load of risk to do it. And I think you can get risk adjusted returns that are, you know, more attractive buying
Yeah.
the very best, and this is the time I can't stress enough. Leaning into that very best end of the spectrum's really important.
Yeah. Well, I know you can't give us specific names, but maybe you can give us ideas of where out in that chain you are looking at. Who, what would be the best? Are we talking about kind of resetting the cycle here and talking about going after royalty slash producing companies, and then after those start making their own, we can start looking at mid-tier companies, producers, or the late stage developers? Are we starting to reset the chain here, or where's that lowest hanging fruit, you think?
Well, I mean, for me, it's all of the above, and for me, for what I do here at Sprott, it depends on the client too, right? Some clients are purely here for the early stage stuff, so if that's what they want, we'll go find the best, new discoveries, or even pre-discovery if that's what they want. We'll go find the best teams and look at who's beat up the most and go and lean into that. For me personally, I like those rare tier one discoveries or high tier two new discoveries. There are a couple that have been on my radar that have pulled back 50 odd percent, sometimes more in the last
Mm-hmm.
3 or 4 months. They are true junior explorers. There's one in Australia that got really good that we leaned into recently. Um, there's some in Guyana. I really like the Guyana shield at the moment. So there's a couple of plays there that I've been nibbling away on. Probably for the broadest basket of people, I think the mid-cap producer space, there's a handful of producers that have exceptionally talented and hardworking management teams that have very good organic growth already embedded in the known knowns. Like, you can look out 5 years, their production profile is going to be 50 to 100% higher than today, just if they kind of hit what's in the bag right now. There's nothing new in terms of discoveries or whatnot. And it's all funded through internal growth, through internal cash flows. So, like, they're already sitting on massive piles of cash. They're not going to have to go and do a massive big equity financing at, current prices or lower. And those companies are rare, but they exist. And again, even those, I've got, probably one of my favorite stocks in that space is down almost 50% from where it was in March. Nothing's gone wrong, but yes, Q2 is probably going to be the lowest quarter of the year. So perhaps some people are playing that angle too. They know it's kind of the low for their production profile, but they got one of the best development projects in the world in the gold space, in our opinion. It's all going to be funded through internal cash flows. They're probably generating close to a 10% free cash flow yield just on the existing package of production, let alone the growth coming, So you can find very, very attractive companies out there across the space, and particularly on a risk-adjusted basis in that mid-cap growthy producer space. And I think you're going to make, if gold even hovers around, 4,000, I can easily see multi-bagger returns from just buying those names here. No help from the gold price, just on the management team executing. And I always find it easier to invest in situations where the management is in control of their own destiny. You're not relying on some hero move in a commodity or a jurisdiction opening up or something like that, because that's completely outside of your control, and it's outside of the company, the people you're investing in control. So if you can find those stories where there's a lot more you're in control of, those stories are particularly attractive to me.
What, before we wrap this up, what's your most hated metal right now, to the point where you really are intrigued?
Like,
beat
up, hated?
Yeah, I mean, it can't be gold. I think that we've pretty much set the table for gold, but anything else out there?
Gosh, that's a good question. I mean, there's a lot all of a sudden, right? You go back 6 months and it was like nothing. It's like, what is hated now?
Zinc? Where's the zinc play these days?
I don't even think zinc's that beat up, but no one cares. So in terms of like care factor, which is funny you brought that one up, because I actually do care on zinc. Zinc's kind of gotten interesting for me just because I can see, like, TCRCs are going negative. Like, there's a real concentrate supply shortage right now. So there's not a lot in the zinc space that you can go out and buy primary exposure to, but I do have a couple of names that have a good chunk of zinc on the side that I'm kind of excited about. So in terms of lack of care, zinc and lead would be pretty up there. Yeah, it's good. I mean, even traditional energy, I feel like there's a lot of gnashing of teeth in oil. Like, people got real pissed off that oil, the oil fundamentals look phenomenal, right? Closing Strait of Hormuz, who would have thought oil basically yawned? So in terms of pure frustration, the traditional energy space is pretty frustrating right now. And I've actually bought a little bit of some energy exposure in my PA today, just because it felt pretty gnashing your teeth out there today. The one I personally probably felt the most is I've been pretty vocal about the setup for platinum the last few years. And then we obviously got that kind of silver-like hero spike to almost $3,000 an ounce around the same time as silver. That's sitting down around $1,500-$1,600 an ounce. So that's done the full silver, 50% retrace thing. Everyone talks about the silver retrace. For me, I went very long personally in just physical platinum, and I still got it. I still think it looks interesting long run. But that's up there with silver as a commodity that's been badgered, but I think still has very interesting supply-demand dynamics.
I remember a couple of years ago, you and I, it was off topic conversation, but it was recorded, but You had mentioned you were very bullish agriculture, and actually we've been diving a little bit more into agriculture on Clear Commodity Network. Are you still feeling pretty good about agriculture?
I do, yeah. I mean, one of my biggest personal investments is in a farmland fund that we have access to. So I kind of play it from an ancillary angle. I've
Yeah.
looked for ways to play the like commodities specifically, but you're kind of left with futures that have really high roll costs, and so it's quite hard. It's quite a hard space to get pure exposure to. Obviously, and then beyond that, you look at all the fertilizer plays, which I do own a little bit of, not huge amounts, because I don't feel I fully understand the sectors as well as I do the metals and mining space.
Right.
But yeah, I think from looking at just the chart perspective overlaid with what I do know of the fundamentals, a lot of the softs look really interesting. Wouldn't surprise me if corn, soybean, wheat, all these things had a really good next sort of 12 months, plus or minus whatever happens on the weather front, right? So there's always a huge weather overlay, and I know everyone's sort of talking about a super El Nino or coming. Like if that really does eventuate, we could have sizable, price moves higher in some of these
Yeah.
commodities. But you're a Nebraska guy, you probably know more about the dynamics
Yeah, I
in the
actually learned
agricultural commodities than I
I
do.
I went up to Northeast Nebraska over the weekend and they actually got their first rain. I mean, it rained all day, all stinking day. But the farmers were super happy because it's been so dry. It was so dry. One of my friends who still farms up there said already in June he was starting to see corn wilt a little bit.
Oh,
Never seen it
serious.
that early. So that's
Yeah,
how dry it's been. So if you're farming dry land, you were just really happy for that moisture. But
interesting.
we just need a lot more of it. Anyways, that's my insight. Take it for what
There
you
you go. Love
will.
it.
So, all right, Sam. Well, hey, good to connect with you, man. It's been far too long, but I wish you a speedy recovery and hopefully see you around this fall, some sort of circuit, as long as you are mobile.
Yeah, thank you, mate. I'm hoping to make it a beaver, so I'm hoping the ankles fully, or not fully healed, but hopefully I'll be mobile by then and I can whip around all those one-on-ones in Colorado. And so hopefully see you there.
There you go. There you go. All right. Sam Broom from Sprott, everybody. That's a wrap here this week. We'll be back Monday morning with the morning briefing. Have a wonderful weekend and be well.